It's such a crux question, because you look at the US environment and the efficiency and the frequency at which deals take place, particularly in places like New York, Boston, Palo Alto, is a function of how institutionalized this market is, where I think most venture capitalists, early stage, will look at a particular business, they'll say, okay, first time entrepreneurs, et cetera, pre-money of maybe maximum $3 million. Exactly what was said earlier. Second time entrepreneur comes along, great idea, you love everything else, maybe pre-money of $8 million. These are real rules of thumb. The interesting thing is that in the entrepreneurial environment, right, if you talk to fellow entrepreneurs, that kind of rule of thumb is in place as well. So what you get is this immediate kind of zone of, I like the term zone of fairness, or, zone of overlap, if you want, where people aren't coming. My own person, I'd done a deal in Boston, I'd gone back to Johannesburg, seen a very, very similar deal in terms of stage, offered the exact same deal, and the entrepreneur kind of stood up at the table and said, "You're trying to steal my business," right? And I think that speaks to the difficulties of emerging market environments. There's just not enough. There are not enough role models. There are not enough venture capitalists, institutional venture capitalists, as opposed to kind of high net worth ex-entrepreneurs or angels, etc., that just kind of starts to smoothen this process out. So that's where using an endeavor is fantastic, and it's unbelievable to have access to this kind of network if you're in a developing market. But I'd say the crux of that is a term sheet negotiation is this unique kind of dance. It's like this courtship. And you've got to be thinking of the subtext all the time. If you're not meeting minds on some of these things, right, and they're critical issues, the chances are, and there isn't all this muscle memory that kind of regulates it, right, the chances are that you're not going to do, either you walk away from the deal really quickly, or the chances are that it's just not going to work in the long term because you're not seeing eye to eye on these things. So it's much more inefficient. It can work, right? But, it came out earlier. You've got to read the signs, and I think good entrepreneurs and certainly good funders of early stage ventures in emerging markets tend to walk away, speaking for ourselves, walk away pretty quickly. If there isn't a meeting of minds, and maybe 6 months later we say, well, let the market tell this guy what it's worth, and maybe he finds a very wealthy investor or something like that. But it's just that much more inefficient and tough.